Hi, everyone. Welcome to our DAT IQ weekly market update. This is our update for July 9. This is episode 299. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy, sitting in for Ken Adamo this week. Special guest today, Paul Brashear from ITS Logistics. He's the author of the ITS Logistics US Port Rail Ramp Freight Index. Welcome, Paul. Great to have you on the show.
Appreciate it, Dean. Thank you.
Yeah. Paul, you're in Texas. Give us a bit of an update on what's happening with Hurricane Beryl.
Yeah, this morning about 3:40, it made landfall. There's some localized flooding on the coastal regions. Have a few friends down there in Galveston that said there was some water that was going over the seawall. But the further inland you get, not too much of an impact. No tornadoes or anything to report of. The port authorities did shut down all the terminals for today. We'll probably see that go through tomorrow at some point. And then operations should resume normal activity as the storm pushes its way out of Texas sometime today. Right. So the biggest thing I think that we got from this was some well-needed moisture in the central part of the state and cooling temperatures, because it was a hot holiday weekend out here.
Yeah, certainly was up here in New England. How about you, Chad? How was it in Florida?
Yep, Sunshine State's looking pretty clear right now. Looking good.
All right, good. All right, Paul, we'll bring you back in towards the middle part of the show. We'll talk more about the intermodal and drayage industry in particular. We'll get started with our market update. Let's start with some of the key trends we're watching in the market today. Spot rates, all equipment types are really following seasonal patterns last week. Dry van rates were flat, flatbed rates were down as they normally do. Reefer was tracking very closely to prior produce season July 4 peaks. I'll have a bit more of that on some of the numbers a little bit later in the show. The ISM PMI index contracted in June for the third consecutive month and the 19th time in the last 20 months, came in at 48.5. Down from 48.7 in May. Anything less than, I think it's about 42.5 over a period of time, generally indicates expansion of the overall economy. So it's still in expansion territory, but down a little bit in June. The Logistics Managers Index, Zach Rogers puts this together. It came out just before July 4, came in slightly down at 55.3. The index expanded for the seventh consecutive month and 10 of the last 11. A couple of the leading indicators moved. Inventory levels contracted, while a very notable drop in warehouse utilization. There was also a tightening of warehouse capacity and, more importantly, transportation capacity, which read in at 50.0. This is the first time the Transportation Capacity Index has moved out of expansion territory since March of 2022. We just got our update from Paul on Hurricane Beryl. And for those new to the show, we have a long-form version of today's report or a market update out this evening. It'll be published at dat.com/market update. This week, we're talking about the top tips for reefer carriers on how to manage reefer motors over the summer. A good friend of mine from Australia who's operated 3 trailers at a time with refrigeration motors hauling bananas across the country, has shared some of his best tips for operating refrigeration motors based on about 25,000 engine hours of operation. It's a fantastic read for those in the reefer business. So let's start with our load-to-truck ratio in dry van. Load post volumes followed post-July 4 fall in freight volumes last week. It was a short work week. Volumes were down about half what they'd normally be. So load-to-truck ratio down significantly, down to about 3.57. It was down about 36%. A little bit higher than this time last year, though, at 3.57. In refrigeration, load posts again followed seasonal patterns. They were down about 43% on the short week. They're about 11% lower, though, than last year, principally due to the softer produce season that we're seeing at the moment. Load-to-truck ratio down by about 14% to 5.84. Interestingly, it's identical to this time last year at 5.84. And lastly, in flatbed, load post volumes down also by about the same magnitude as flatbed and reefer. Carrier equipment posts were down also on the shorter work week. Load-to-truck ratio down by 31% to 9.14. That's about 11% higher than this time last year. Having a look at our year-over-year look at spot rates, last week the national average dry van line haul rate remained flat at $1.70 a mile on a shortened work week. Remember, these are line haul rates excluding fuel, so at $1.70 a mile, that's the national average line haul rate. Spot rates last week were identical to this time last year, and they're also identical to the 8-year average week-over-week change for the week of July 4. So pretty much on track with what we'd expect in the shorter week. On our top 50 lanes, though, based on the volume of loads moved, rates are up 6 cents a mile, averaging $2.12 last week, which is 42 cents a mile higher than the national average. Interesting news there. In refrigeration, temp control rates up just under 2 cents a mile, averaging $2.04. They're about 3 cents a mile lower than last year on a 15% higher volume of loads moved. From mid-April to July 4, which is sort of our unofficial produce season from the Vidalia onion pack date to July 4, we typically see spot rates increase by 19 cents a mile over the 11-week period. That's pretty much exactly what we saw in this year. So produce season has had a similar impact to dry van rates and reefer rates to what we'd normally see. Having a look at flatbed, after increasing 2 cents a mile in the lead up to July 4, flatbed rates dropped 3 cents a mile last week. Loads moved plunged by about 32% week over week. At 2.05, flatbed line haul rates are 6 cents a mile lower than last year, but higher by the same amount compared to 2019. So let's have a quick look at our short-term forecast. Let's start with dry van. Remember, those new to the show, the blue line is the rolling 7-day weighted average of historical rates for loads moved over 550 miles. So they exclude fuel, line haul only. Our ratecast model is in green. That's the green line going out 35 days. Red is the short-term model. It more heavily weights data seen more recently, and then the yellow and grey blends of the two. We are working on an update to our forecasting out over 35 days based on some recent customer feedback. We're heading in the direction of just showing ratecast out 35 days, which would be the green line, with two lines that show the high-low average. And with that, we'd probably drop the red short-term and the grey and yellow blended model. So that change should come in the next couple of weeks. So let's start with dry van. Rates are essentially flat through 8/11 out the next 35 days, mostly model agreement across the four models. Rates are down 2 cents a mile through 8/11. In refrigeration, again, we're seeing more model accuracy there. They do drop about 7 cents a mile out to the third week of July before coming back up again to end about 5 cents a mile down from where we are today out to the second week of August. Again, that's pretty much what we see each year. And in flatbed, very strong model agreement. Rates are heading south as we have seen for the last couple of weeks. Ratecast is expecting rates to decrease by about 7 cents a mile out to the second and third week of July. August. All right, so let's move on to Chad's section. He's got an update on the contract shipper side of our market.
Yep, thanks, Dean. So everything Dean's covered up to now has been on the broker to carrier perspective, so capacity and rates. So this is showing a dry van shipper contract and spot mix procurement. So contract rates in blue there, most recently 83% mix of contract rates and 17% mix of spot rates. If you were to zoom in there to the far right, you can see a little blip there up to about 21%. We did see a spike in the mix of spot rates, which went up significantly. We're curious to see if that will come down as we revise our numbers and get more contribution data in. But it does seem to have calmed down a little bit, down to 17%. Spot premium ratio, the black trend line there, has been trending up since mid-May. So we've had a lot of momentum and trend there. We're currently at -3%. That means that spot rates are 3% below contract rates on the shipper side. So we'll go on to temp control now. Similar types of trends. The trough on the spot premium ratio for temp control was early May. And a lot of trend and momentum there with spot rates increasing and contract rate decreases slowing down a little bit. So we're at -2% there on the temp control spot premium ratio. And then moving on to flatbed traditionally having a much higher mix of spot rates or loads rather at 37%. That's due to short-term lanes, seasonal lanes, and that sort of thing. spot premium ratio at -1%. So that is holding pretty much bouncing around that -5 to -1% there. So that's a wrap on the shipper side.
Okay, let's bring Paul back in. Paul, your latest rail ramp index report shows that markets have stabilized, despite the fact we've got the possibility of Canadian rail strikes and interruptions up there. We've got possibility of ILA strikes on the eastern Gulf Coast. Do you think we can expect more of the same stabilized market the rest of the year, or are things set to change?
Yeah, unfortunately, what we're seeing at ports and ramps right now throughout the U.S. are a result of issues at origin. So right now, there's not a lot of boxes available for shippers to get goods over. There's a lack of space on vessels. So this is kind of a result of some headwinds that shippers are feeling overseas right now. Thus, ease of use at our time right now.
Wow, I would not have thought that. So it's kind of the calm before the storm, do you think?
Exactly. I mean, right now we're starting to see forecasts for an early peak. So we're going to start seeing a lot more import volume come into the United States as we get into the back end of July, August, September.
Right.
And with that, you're going to start seeing a lot more congestion. Now, one odd thing that we're starting to see, something we haven't seen since early in the post-COVID congestion period, is that due to the lack of space available on vessels, some shippers are having to book to new entry points into North America and cancel their IPI legs, which is causing the need for additional trucking capacity in new markets and additional line hauls as well.
Wow, that's interesting. So is there any particular ports that we should be watching from a truckload perspective that might not be on our radar?
Yeah, one thing that you'll start seeing a lot more of as IPI legs are canceled, and those are those legs that when a container comes into the United States, it gets put on rail and taken further in and pulled off a rail ramp. So as those start being canceled, you'll start seeing a lot more demand for domestic truckload for transload capacity in the big major ports. So LA, Long Beach, we're seeing a lot of that activity now. Savannah, of course, New York, New Jersey. But interesting enough, we're starting to see a lot of requests for Seattle, Tacoma, Vancouver, and Prince Rupert as the labor discussions start breaking down up in Canada.
Wow, that's a similar thing we saw during the pandemic, right? Where we saw I think Seattle is something like 1,200 kilometers closer to northern China.
Exactly.
From a sailing perspective. So, and of course, up in Prince Rupert, you've got the on-dock rail system straight through to Chicago. So
correct. Yeah. And that's feeding a lot of the manufacturers and consumers of goods in the Midwest, right?
Wow.
And, one thing to kind of call out there too is we're seeing significant amounts of volume go back to the West Coast. So LA, Long Beach grabbed a lot of market share as shippers started avoiding the East Coast to hedge against potential labor strikes and activity on the East Coast. And then Trans-Pacific lanes opened back up when the Red Sea was closed, going from Asia back to LA, Long Beach primarily, but Seattle, Tacoma as well. So you should start seeing a normal peak on the truckload side as these goods make their way in on traditional trade lines that we've seen, previous to the COVID pandemic and folks avoiding the West Coast last year due to the strikes.
Right.
Hey, Paul, there's a lot of dynamics at play here. If you're in a shipper's seat, are there any areas of opportunity to take advantage of?
Yeah, the first thing I would say is, keep your ocean carriers close and your NVOs closer. So most available space that we're seeing right now is coming from NVOs. And if at all possible, avoid LA, Long Beach where you can. Some folks have that in their supply chain, others don't. Start gravitating towards providers that are not regional capacity based. You get a lot of that in the drayage market. So that these nationwide companies, which, ITS, of course, is one, that can dip into, have dedicated capacity, let's say in a Savannah and a Norfolk, but also in LA, Long Beach, can give you capacity at reasonable prices that you don't have to dip into the spot market for if some of your supply chain starts getting out of whack. So that would be the first thing, is vet the heck out of your trucking capacity and your dray capacity to make sure that they can flex in to new markets, get new pricing on the books now, and start utilizing those folks as you start looking at new places to book into the U.S. Because more than likely, most shippers are going to be needing to bring stuff into ports that they're unaccustomed or they did not plan for in 2024.
Yeah, that makes sense. So with the potential of some striking on the East Coast, and I think that's September, October, is that right? What is the last window of opportunity to shift lanes to the West Coast if a shipper wanted to do that?
Well, usually a good rule of thumb is 4 to 6 weeks, but there's not a lot of space to do that now, so there's less flexibility. So the plan is to do it now and start having discussions now or as soon as possible to see what kind of lane and capacity you can get on the ocean carriers. One thing to call out too is more than likely we're going to probably see some sort of resolution to the talks. We're not seeing anything that's showing that there's going to be large scale strikes along the eastern seaboard or through the Gulf. So probably a good idea just to hedge, right? Make some volume available to the West Coast or the Gulf, and that way you're kind of covered regardless of what happens. That's a really sound strategy. They got a lot of more savvy shippers through post-COVID congestion. Utilize IPI for SKUs that can take additional time. Utilize the East and the Gulf if you can take the transit through the Panama Canal, but continue to push volume to the West Coast. Don't move everything into one place, because as there are so many things that could happen right now, the one thing that is assured is that if you're all hedged in one direction, that would be the one thing that puts a stranglehold in your supply chain.
Paul, you mentioned the Seattle, Prince Rupert, Vancouver area. Do you think that the Canadian rail strike will have an impact there and maybe push shippers away from that area?
Yeah, I do believe that even if there is not a strike, the potential of one is going to cause, similar to what we were just discussing, this hedge.
Yeah.
Right. This planning just in case. So we're already seeing that. We've already seen the contingency plans. We're part of the contingency plan with our clients. So there are volumes that are shifting away just in case. It's not full scale at this point. So there will be an impact, of course. And then, another thing too is to make sure that you're taking a look at your modes and how you're going to execute. A lot of times that Prince Rupert area in particular is very hard to get a dray off, a transload, and trucking capacity up into that market. So, you should be taking that into consideration now to make those contacts. If you're lucky enough, test some volumes through there so you can get pricing in place now so that pricing holds,
right,
instead of waiting for it all to happen the same time that everybody needs the capacity. Right. And then you're in the spot market paying additional costs for that transportation.
Yeah, that's good advice. Chad, what else you got there?
I was curious, switching gears just a little bit, are you seeing an increase of nearshoring to the Mexico market, and is that causing an increase in volumes over the border?
Yeah, that's one of the reasons that we've opened up this office in Fort Worth, Texas. So this facility will also have oversight to our cross-border operations in Laredo. And we have gone where our clients have gone. So significant amount of nearshoring is currently in place. There is a need for additional capacity and solutions to get freight into the U.S. from Mexico. We're not the only ones doing this, but we are trying to be one of the first to do so for bringing in new capacity. So there are going to be a significant amount of issues that are going to arise over time, but we're hoping that us being in position now will kind of set our clients up for success and aid them as they need these services.
Paul, one of the things we've noticed during the pandemic was the inflow of goods, both break bulk and containers, into the Port of Houston. Obviously, they've invested a lot of money in, gantry cranes and on docks, on dock space. But we noticed on our truckload side a lot more volume moving to Fort Worth in particular, and a lot more warehouse infrastructure around the ramp that's there in Fort Worth. Is that still going on? Is it sustained or is it growing? And the second question is, there was talk of rail, intermodal providing a direct rail link to that market. Has that occurred?
Well, to answer your last question first, no, not in large scale.
Right.
You kind of hope, even though rail providers are usually pretty slow to adapt to change.
Right.
You hope that happens relatively quickly.
Right.
With the increase of infrastructure spending due to the Inflation Reduction Act, you're starting to see a lot of project-based freight, to what you were saying, come in to the United States, and particularly through the Port of Houston and the break bulk facilities there.
Yeah.
So another thing that we oversee in this Fort Worth office is a special project and international project logistics. And that is taking, a lot of out of gauge, large pieces of machinery off dock, get that on specialized equipment, and push further into the supply chain. Right now, we're seeing a lot of alternative energy draw a lot of that capacity and drive that demand. So solar, wind, bridges, roads, construction, stuff like that.
Yeah.
is driving a lot of that activity. And again, us position ourselves here. We've got a facility up at the BN in Fort Worth that helps our clients store that product closer to end user to get it further up into the Midwest.
Got it. Well, that helps, certainly explains a lot of the flatbed volume and specialized volume we see coming out of the Houston market. It's by far one of our largest flatbed markets in the country for spot.
We're seeing a lot of steel too. I
Yeah.
mean, both import and domestically produced steel eat up a lot of that capacity as well.
Yeah, a lot of Brazilian steel coming into that port.
Exactly.
Yeah, that's fascinating stuff. So big markets to watch, right, from a truckload perspective, where there's transloading. So that would be Ontario, the Inland Empire market, Savannah, and New York, Port of New York, New Jersey, mostly New Jersey, right?
Correct. Right. And we haven't seen any significant volume spikes in the Houston market.
Right.
So we're going to hold off red flagging the Gulf Coast for the most part. Right. But the only one that I would call out that might be an outlier is Seattle, Tacoma. That one kind of took myself by surprise as well.
Right. Okay. Fascinating stuff. Great to have you on the show. Chad, anything else before we wrap up?
No, that's a wrap for me.
Yeah. Well, it's fantastic. Before we wrap up, tell us a little bit about ITS Logistics and your index and how people can get hold of your monthly report.
So we publish that on all social media outlets that our marketing team pushes that to, but it's always going to be at ITS Logistics or its4logistics.com on the drayage and intermodal page. And we also push that out to any and all that want that on a subscription basis at no additional charge.
Right.
And ITS Logistics is a asset-based, asset-backed third-party logistics company with over 10 million square feet of warehouse throughout North America. I think we're 2,500 trailers and trucks throughout the United States as well.
Yeah.
And fast-growing top 20 transportation logistics company in the United States.
Yeah, real success story. I'm glad to have you on the show. So we'll get you back again. Maybe around peak season might be a good time to get you back in to see how all of this has panned out.
Yeah, definitely. I'll keep you posted on if we're seeing a major shift, paradigm shift. Yep. And at a minimum, at least you'll get a heads up before chaos ensues. Okay.
Yeah, exactly. Appreciate that. All right. Couple of shout outs this week on the soon to be released. I think it's out this Friday. Professor Kaplis is talking to Gonzalo Cordova from Home Depot about how they're using AI in supply chains. That Freight Find podcast will be out this week. Don't forget DATCon is on in Kansas City, October 22 to 24. Go to dat.com/DATCon. Remember, CVSA is gearing up for Brake Safety Week, August 25 to 31. You can expect a lot of out-of-service activity and service failures that week. On next week's show, Tim Denoyer from ACT Research is joining us to talk about new truck and trailer orders and truckload capacity. Chad, anything from you before we go? Any shout-outs on your side?
Nope, I think you covered it.
All right. Okay. What about the Shipper Day at DATCon? Is there anything special shippers should be thinking about?
Yep, showing up a day early. We cover just shipper topics. So we'll be pulling in our shipper roundtable, which we hold monthly, which is held this Wednesday. So we'll be covering which topics shippers want to talk about at DATCon Day.
Gotcha. Okay. All right. I'm heading out to the Iowa 80, the world's largest truck stop, to the Walcott Jamboree tonight. I'll be out there with my truck and at the DAT booth on Thursday, Friday, and Saturday. If you're passing through Walcott, call in and say hello. And with that, another show is in the books. Be safe, be nice to everyone, and we'll see you here next week at 10 a.m. Eastern, 7 a.m. Pacific.